Hello friends, welcome. Friends, few days back I had done a similar video which I am going to do today. Now friends, why I am repeating this video? The reason I am repeating this video is that I want to make one point very clear and I want to analyze this with you as to the quality of foreign exchange reserves that we have. We have to investigate that. Why it is important? The quality of foreign exchange reserve is important because we all are euphoric about the fact that India's foreign exchange reserve is growing day by day, which you can see in the dashboard on the right hand side of your screen, right? But what constitutes this foreign exchange? How this foreign exchange is measured, right? And how can you measure the health of this foreign exchange, the quality of this foreign exchange is what we are going to discuss today. Now, in order to do that, I am going to take help of one dashboard which I have created, which is on the left hand side of your screen, called India's balance of payment situation, right? Now, balance of payment is directly linked with foreign exchange. So, if you are an economics student, you will understand this very well. But for a layman, I would like to simplify this because the balance of payment sheet that we have on the left hand side of the screen will be enabling us to evaluate whether the quality of our foreign exchange reserve is good, bad, neutral, etc. Now, when I say foreign exchange reserve good, bad, neutral, what does it mean? This is what I mean by that. See, if your foreign exchange reserve quality is going to be good, then it is not going to evaporate so easily because of any external shock. It is going to be resilient. It is going to remain steady. You are not going to lose your foreign exchange because of any kind of perception that the foreigners will have on the Indian economic situation. Because maybe the world may go into a war or something might happen which might lead into a situation that India may not be a country to invest. And whatever investments that the foreigners have made in India, they will like to pull out. Now, if they pull out those investments, which are dependent on not only India's economic condition, but the global economic condition, then our foreign exchange reserves are going to deplete. We don't want that. We want our foreign exchange reserves to be resilient. Means it should be immune to shocks. And that is why it is important to measure the quality of foreign exchange reserve, and the balance of payment sheet is going to make us determine that quality. And that is the whole purpose of me doing this video. Though I am not an economics student, I am actually do a lot of data analysis. I thought that all the work that I have done to aggregate data, which is RBI is putting out in their website, on a meticulous manner, quarter by quarter, why don't I aggregate that data in a manner which becomes useful for the viewers to understand this particular fact which I am making before you. So without wasting our time, let's begin. Now, what is balance of payment? Now, balance of payment, this is the sheet and this is the dashboard which is on the left hand side of your screen, which talks about balance of payment. Sorry, all scam calls, right? I'm very sorry for that. Okay, so this is the balance of payment situation that you see right in front of you. The line item which is marked as serial number 1 is the India's overall balance of payment. If this number is positive, your foreign exchange will become positive. Means it will grow from the value which was earlier from the earlier quarter. Means if it is 32.4 for $4 billion, this number is going to grow 32.4 billion number higher, right? If it is going to be negative, like $16.02 billion, the number is going to go down. For example, let's look at this number. FY22 Q4, FY22 Q4, right? See, the number in FY22 Q3 was $635.2 billion. This number went down and became $622.9 billion. By the way, this is basically an average foreign exchange reserve number, not at the end of the quarter, just to mind you, when I did this calculation, because we have got other time scale to make sure that we are able to extract the quality of the foreign exchange, the value of the foreign exchange across that particular time period. I have taken an average, right? It is not the end of the quarter, just to make sure that this point is being explicitly stated in the beginning of this analysis itself. But it will give you an understanding that within that particular period, if there is a positive balance of payment, then the number is going to go high. And if it is going to be a negative balance of payment, the number is going to go low. Now, there is one more point to understand. The overall balance of payment situation is not the only line item which impacts our total reserve. Our total reserves are an aggregation of foreign currency assets, gold and SDR. So, when we talk about overall balance of payment, we are actually influencing foreign currency asset, typically. That is the point which we should be taking into consideration, because gold and SDRs are acting independently, right? Now, so leave the gold and SDR aside, we will be able to, because these numbers are not that significant compared to foreign currency asset, we can safely assume that the overall balance of payment situation, if it is positive, our overall foreign exchange reserves are going to increase. If it is negative, it is the overall foreign exchange is going to decrease. Now, let's understand what overall balance of payment constitutes. The overall balance of payment constitutes three different items. One is the current account, another is the capital account, and the third is this one, errors and omission. So there are primarily three accounts. Actually, two accounts. Errors and omission is just to basically add the numbers so that everything matches. So there is a current account, there is a capital account. Now, what constitutes current account? Then only we will to understand whether the quality of our foreign exchange is becoming better or it is worsening. Now, current account is made up of two main items. One is merchandise, another is invisibles. Right? You can see 1.1 plus 1.2. Merchandise and invisible. Merchandise is the trade in goods and services. The total deficit or surplus that you accumulate on account of trade in goods and services across the border is what constitute merchandise balance of payment. Means if India is exporting $100 worth of goods and importing $150 worth of goods, then we have a trade deficit of minus $50. Right? That's simple as that. Now, invisibles constitutes services, transfers and income. Let's talk about invisibles later. Let's focus only on merchandise first. Now, if you look at merchandise, you will notice that our situation as far as goods balance of payment is deteriorating day by day. How can you say this? Because these numbers are becoming increasingly red and increasing day by day. Means we are importing more than we are exporting, and that is happening in spite of all the policy announcement which the government of India has done till date to increase export and make India Atmanirbhar. It's not working till now. It may work in future, but now we are not getting the dividend. It's clearly evident from this data. Now, if I go 12 quarters back in time, you will be able to see how these numbers have actually become worse or better. So even 12 quarters back in time, our merchandise trade deficit numbers were increasingly worse, except for the fact that we were in FY21 Q1, FY22 Q2, these numbers went down, and these were basically influenced by some seasonal effect, either because of COVID or something, but these numbers went down. But if you look at the earlier period numbers, you will find that these numbers are continuously bad, and even today. Let's go. So this is the current number. This is the 12 quarters back time scale number, means we have got 12 quarters back in time, right? So this, let me explain what I mean by this. So this is, if you see FY21 Q3 till FY24 Q2, right? This is the time scale that we are. Now if I type 12 here, means we will basically go 12 quarters back in time, right? So I'll pay enter. Now you see FY18 Q3, FY21 Q2, right? So that's how you can basically see what happened 12 quarters back in time. Now if I go 24 quarters back in time, let's see what the numbers were. Still the numbers were bad. So it is not, so these numbers were low at 24 quarters back in time compared to what the numbers are today. Can you see this? And especially in the recent times, the numbers were very bad. Means that our merchandise trade deficit is increasing. And it is happening in spite of the fact that the oil prices have stabilized, which means that we are doing worse in some other items where our trade deficit is not getting managed. So from a merchandise point of view, our current account is actually getting pulled down. Very clear. Now, what is helping our current account deficit not becoming so bad as far as merchandise is concerned is the invisibles. Now, invisibles consist of three items: services, transfers, and income. Now, services is what? The service trade that we are doing on a regular basis. Means our service trade is surplus. Means whatever services that we are selling, it's much more to foreigners, to foreign countries than what we are accepting from them. So those services which are basically getting traded to India is less compared to what we are trading outside India. So which is a very positive thing. So one of the important reason why we are doing our current account is not going haywire is because of service trade, and where the policy initiates should be further enhanced to enhance this further. If you are able to enhance this further, then the shock on account of merchandise trade, which may happen because of shock in oil prices, can get mitigated significantly. So this will become our insurance policy or a shock absorber. So we have to focus on services. If you don't focus on services, then what will happen is that we will continue to rely on external shock which we have no control. Like for example, fuel import. We have no control. If the oil prices go high, our balance of payment situation will go bad. So we need to have a shock absorber, and one of the important shock absorber is services. Therefore, if you grow the services number significantly higher, then we will be able to mitigate the ill effects on account of merchandise trade deficit. Okay, let's go 12 quarter back in time and see how the services are doing. So services were consistent and they are doing reasonably well, and it is going better and better. See, 12 quarters the numbers were less. Now the numbers are significantly better than what it was 12 quarters back. Now, another important thing is transfers. Transfer means that if we as an individual go outside and work in some foreign country and we make remuneration, we earn remuneration and transfer them to our relatives in India, those are transfers. And India is a significant recipient of transfer, means those people who are working in Gulf countries or foreign countries, they are contributing significantly to our balance of payment situation, which is clearly visible from these numbers. So let's look at this line. Let's focus on row number 15 and let's go 12 quarter back in time and see what happened earlier. So look, the transfers are actually increasing. Let's say 24 quarter back in time. So see, it was lower. Now we are basically doing much better recent times. So this is also acting like a good shock absorber in against our goods, negative balance of trade as far as our merchandise are concerned. Another is income. Now this is actually not a good thing, because income is what? If anybody has made investment in India, any foreign country, foreign individual or a corporate has made investment in India, he has to earn return on investment, and this is the outflow on account of that. Now, more and more investments you are making in India is good, but the returns which are flowing out from those investments which are being extracted out of India, those are going to impact our balance of payment negatively and will pull down our foreign exchange reserve. And we are clearly seeing that the negative incomes are rising. So if you look at here, let's go 12 quarter back in time and let's see what the numbers were. You can see that the incomes were low at that time and is increasing. So our foreign exchange overall balance of payment situation is decreasing on account of more and more income being pulled out. Let's do 24 quarters back in time. So if you see, the incomes were pretty less at that time, and then now in the current period, income less means it was less from the point of view of in extracting from India. Now these numbers have gone very high, and these people are extracting more and more value out of India in terms of return on investment. So this you have understand. So just to summarize, overall balance of payment, we have got current account. Current account makes up two line items, merchandise and invisibles. And then merchandise invisible consists of services, transfer and income. Services transfer are acting like a good shock absorber, and we will continue. If you continue to do good on these, then we will be able to mitigate some of the shocks on account of negative merchandise trade because of external factors which we have no control. Okay. Now let's go to the other item, which is called capital account. Now capital account consists of what? Foreign investments, which includes foreign direct investment and portfolio investment, and it consists of other items like loans, banking capital, rupee debt, and other capital. Right? But these items were less, so we will not talk much about these items. Let's focus on only two main items, which is foreign investment and foreign direct investment and portfolio investment, which you see 2.1.1 and 2.1.2. Now, if you look at the situation as far as what is foreign direct investment? Foreign direct investments are investment which is not made in the stock market. It is going directly in terms of bricks and mortar or in companies directly. For example, if there is a company which is an equity investment is made by a company, that is qualified as foreign direct investment, right? But if you are making investment in stock market directly and exchanging hand stocks, then that is called portfolio investment. Now, what is good? Foreign direct investment is good because it is going to be less volatile, it's going to be more sticky. Because anybody who makes investment in terms of brick and mortar, it has to wait for a certain duration of time before he can liquidate his investment. Whereas in portfolio investment, what happens is that as soon as you make investment in the stock market, depending upon the external condition, you take out the money and you invest somewhere else so that your money keeps growing, which is more volatile in nature. So we would like to have more foreign direct investment than portfolio investment. Portfolio investment is just impacting the stock market, right? Now, if you look at the foreign direct investment situation, again, the numbers are dwindling down. See, from FY23 Q2, if you see $6 billion, $2 billion, $6 billion, $5 billion, then minus $287 billion, $287 million, the numbers are going down. Versus portfolio investment, of late, the numbers have increased. Now, it is very strange where the foreign direct investment numbers were high, the portfolio investment numbers were low. See, it was negative. See, at FY22 Q4, FY23 Q1. Now, let's go back 12 quarters back in time and see what the situation was. Now, you see, India was doing pretty good as far as foreign direct investment 12 quarter back in time. See, these numbers are all green, right? Portfolio investments were not that great. Let's do 24 quarters back in time and see. See, India was doing good because all greens but of recent time, the numbers of foreign direct investment are going down, which means there is something wrong. Somewhere there is something wrong because we have been talking about PLI policy, lot of things we are doing, which an investment made under these policies should be attributed as foreign direct investment. Now, if these numbers are going down, there must be something which is wrong somewhere, which we have to investigate and figure out what is going wrong. Because the capital account, if the capital account on account of foreign direct investment increases versus portfolio investment, then the volatility of foreign reserves are also going to go down because this is going to be more sticky in nature, foreign direct investment. So this number on top, if it is increasing because of foreign direct investment, then the volatility of foreign exchange reserves are going to reduce, right? So now you understand what the situation is as far as foreign direct investment is concerned. And then we have got loans. Now loans, you know that there are the loans constitute of external assistance, commercial borrowing and short-term loans to India. And these are very small numbers and let's look at how these numbers have changed over a period of time. They haven't changed significantly, so we can safely ignore it. It's not constituting a very significant factor as far as our foreign exchange reserve is concerned. Then we have got banking capital. Let's look at how the banking capital's numbers have changed over a period of time. These are also fine. These have also contributed at some period some significant numbers, but these haven't changed very significantly over a period of time. Let's see. Yeah, because in recent times, the numbers have increased in certain period, like for example, FY23 Q3 and FY24 Q1. The commercial banks, because if you add the item number 2.3 is 2.31, which is this item, 2.31 commercial bank and others, right? And that is where the numbers have basically increased, right? And then we have the rupee debt service, which is nothing, very less number. And then we have other capital, which we can simply ignore. So friend, in net, what we have learned to summarize this whole video, we have very clearly said that analyzed in this video that the volatility of foreign exchange reserve depend upon the quality of the investments and the rupee earning, that is the dollar earning that we are making in India on account of balance of payment. If our balance of payment is stable, situation is stable and is less volatile, our foreign exchange reserves are also going to be less volatile and it's going to be stable. And that's what we need. Because if our foreign exchange reserves are going to be volatile, then we will be at a risk at situation where we might be in a crisis, right? We might be in a crisis situation like what happened in 1990, where India had a very big challenge as far as foreign exchange reserves are concerned, when we have to basically take gold and put it in Bank of England in order to recover, in order to earn foreign exchange to meet our expenses as far as imports are concerned. We are not in that situation, by the way. I'm not saying that India is in such a bad situation, but we need to do better. We need to ensure that our foreign exchange reserves, quality of foreign exchange reserves are good, and that's where we have to focus on in enhancing and reducing the volatility of these line items which constitute these reserves. And one of the important line item which is actually constituting this reserve, two important line item where we have to focus on, one is merchandise deficit, and another is the foreign investment, direct investment. Because foreign direct investment is also less volatile and it remains there in the country for a larger duration and is not getting pulled out so easily because it is on brick and mortar, mostly brick and mortar. And then there is one line item called services, where we can make more focus, because it is going to act as a shock absorber, and in order to mitigate the negative merchandise deficit, which is in account of our negative trade deficit, that is, we are importing more and exporting less. And in some situation, we will have no control because of price increase of crude oil prices, etc. At that time, services exports are going to bail us out, and we need to focus on that. So friends, I think you have understood. I think this video is extremely clear that how we can increase the resilience of foreign exchange reserve in our country and make this less volatile and less stable, so that India's situation as far as global is concerned, situation markets are concerned, is more resilient and more robust, and India can resist global shock on account of wars or any other situation as far as any kind of external situation that happens on account of deteriorating global economy, and which is beyond our control. And I'm very sorry, friends. I should have switched off my phone. This this kind of spam phones are creating a lot of problems and making my life miserable. Thank you very much, and I hope that you also might be facing all these issues as far as spams are concerned, and we need to figure out another big remedy for this to get out of this situation. Thank you for your time. I'll come back to you with the next video next time. Thank you very much.